Hi everyone, Buyer's Agent Jay Pace here for Providence Property Group with a market update for the month that was March 2022. The latest hedonic value index numbers are out from our friends at CoreLogic, and it shows the top three growth capitals for the month were Brisbane, Adelaide, and we had a tie this month for third place, being both Perth and Canberra. Now, we are keeping a very close eye on Perth and expect it to be fashionably late to the party. As predicted in our November video, Sydney and Melbourne prices are cooling off with slightly negative returns. I actually think it's pretty important that we explore why the investment dollar looks like it's jumped on a plane and decided to start traveling around the country. With interest rates at record lows, yields have never been more important. Over the years, we've seen investors seek high cash flow, all right? But unfortunately, capital cities with higher rental yields may be located in areas that leave some investors feeling out of their comfort zone. The largest of Australia's populations are in Melbourne and Sydney, and for the longest time, these were also the most expensive cities until Canberra knocked Melbourne out of second place in 2021. Now, the banks are slowly increasing their rates, which means serviceability of loans will become more difficult. Investors who are planning to hold for the long term will need to offset these higher fees and will search for property with a yield that will minimize their weekly/monthly holding costs. And this is going to leave investors with little choice but to leap in and buy in capital cities where they would have previously rejected. I'm just going to move my head up here. That's better. What else we got next? Typically, as prices increase, rental yields decrease. So Sydney and Melbourne, two of the three most expensive capital cities in Australia, also have the lowest rental yields. And this makes them less affordable for investors and hence becoming less attractive. According to the RBA, around 30% of property purchases are investment. So how are recent trends in prices, yields, and interest rates affecting owner-occupiers, Jay? Well, I'm glad you asked. All of these factors make buying a home less attractive for owner-occupiers as well as investors. Why? Because owner-occupiers can rent a property in a more desirable suburb for significantly lower repayments than if they were owning a property in a less desirable suburb. So I think it's very important that we look at this. Now, this is resulting in an increased trend of first home buyers opting to buy an investment property in an area that they can afford whilst continuing to rent in an area that they love. And let's face it, if you look at the first homeowner grants and those government grants, they're actually not that attractive. So for some people, they go, well, if I buy somewhere that's cheaper, I'm probably going to save much more money than what I would in buying in an area I don't want to be in because I'm getting a grant from the government. I think that's really important to think about. The strategy is known as rent vesting, when you buy where you can afford, but you live where you want. Now, this chart shows the price increase of the average residential dwelling over the last decade. Nationally, our average was about 70%. Now, we predict more owner-occupiers are going to convert themselves into investors and give up on the dream of owning their own home. It's going to be very interesting to see how the proportions of investors to owner-occupiers affects that market. Now, the famous saying goes, history doesn't always repeat, but at times it rhymes. Now, much of what's happening in the market today has happened in some shape or form in the past. And during the previous property cycle, we saw similar demand for yield, location, resulting in these results here. And as you can see, up there in the chart, Melbourne, 314%. Sydney, 235.8%. Brisbane, nipping at Sydney's heels, less than 2% behind at 234.4%. And Perth at 211.5%. Take your time here, pause the video and just check out this chart because it's from 2000 to 2017 and it's got some great information in it. Now, this chart shows the change in Australia's population over the last 49 years, almost the last 50 years. As the amount of investors increase, so will those considering interstate purchases. As money pours into those higher yielding cities, price points will naturally rise due to increased demand. Now, my red pill moment occurred when I learnt about the property cycle. At Providence, we are well known for our understanding of the property cycle, and if you haven't watched our videos already, I recommend that you jump onto our YouTube channel and educate yourself. Now, the future of property is a lot more certain than most people understand. And this is because most investors don't study history. We're keen students of history, and this is our description of the real estate cycle. We believe fortunes are built on market cycles. The property cycle occurs across an 18 to 20 year period. On average, about 18 and a half years. The cycle clearly historically repeats itself. Australia does not generate its own cycle. It actually follows the US cycle by about 12 months. And we documented this as 4 phases and 24 stages. And these stages do overlap. So there's no, singular way that this thing pulls itself out. These cycles have been identified going back for many decades. And based on history, what we're expecting to see is some very good growth within the next 5 to 6 years. Now, you can go back at some of our videos that we did 5-6 years ago and see that we were talking about these areas of the cycle. And Providence has been around since 2006. So you'll see videos from even before then when we passed through the previous cycle. It usually takes us around 40 minutes to actually go through this entire cycle. I don't have the time today. We will be conducting a special webinar dedicated to the property cycle, so keep an eye out in your inbox for an invite to that event. We have well and truly entered the third phase of the property cycle. This phase is known as the second upswing or the boom phase. Property price growth is typically stronger in the second upswing than it was in the first upswing, and the second upswing is the most optimistic part of the property cycle, the party phase. There's going to be a tremendous amount of money to be made here. Stage 13 is usually 2021 to 2024, as we predict. Prices to get on the move again. We already saw this in 2021. We had the second largest increase in property prices that we've seen in Australian history. Falling yields, we're seeing that now. The land boom continues as property prices in housing outperform units in townhouses, and we're seeing that. We see announcements of incredible optimism, like the world's tallest buildings, and these tend to open at or just after the peak of that cycle. Now, stage 14, we expect this around 2025, rising interest rates, lavish government spending for public works, interest rate rises into the end of the business cycle. So central banks are not able to really engineer a soft landing when it comes to things like this. And central banks are slow to raise rates during the expansion phase. So what happens is they have to play catch up, and they start to push them up faster and faster. And we're going to see that. We definitely will see lavish government spending from the highest tax revenues in cycle history. This is the boom in full swing. We saw this last around 2004, 2005, and 2006. Stage 15, probably around 2025, we'll see this. Real estate activity is frenetic. We see a peak in materialism from real estate profits, which are near their peak in the cycle, and falling yields. The good times definitely do continue. More and more investments are made on hopes of future capital growth, which will not always be there. Rather than a decent rental yield, we see a peak in luxury good consumption, peaks in collectible consumption, record collectible prices. Stage 16, around 2026, activity slackens, but confidence remains high. And this is the peak of the cycle that we're expecting in 2026. Borrowing power is maxed out. There's no future room for property prices really to grow. An enormous amount of money is going to be made during the boom period. This is not something you want to miss out on, but the party will be over, okay? But don't think that because the party is going to be over, I'm not going to do anything now. Take advantage now while you can. You can see that from this chart, the listings for sales currently are about 30.4% below their 5-year average, which is another reason why we're still seeing that upwards pressure on prices, because supply and demand is just in full effect here. I wanted to let you know that our professional agents are here to help you. For almost 2 decades, we've helped Aussies locate, assess, and negotiate their ideal home or investment property Australia-wide. Stop procrastinating. Contact us today. Let's talk about the market. If you like what you've seen here and you want to keep up to date with what's going on in the Australian property market, make sure you jump on our YouTube page, like the channel, subscribe to it, and you'll get more video notifications. I want to thank you for your time today, and I will see you next month.